Hi, welcome to Bite-Sized Accounting. Imagine a doctor finishes examining a patient and says, "Everything looks healthy." That is one type of conclusion. But what if the doctor says, "Most things look fine, but one issue needs attention"? Or, "The condition is serious." Or even, "I cannot give an opinion because I did not get enough information"? That is exactly how audit opinions work. At the end of a financial statement audit, the auditor must communicate one major conclusion. Can users rely on these financial statements? The answer comes through the audit opinion. Today we are bringing together the four major audit opinions: unqualified opinion, qualified opinion, adverse opinion, and disclaimer of opinion. By the end of this lesson, you should be able to explain what each opinion means, when it is issued, and why it matters. Let's begin. An audit opinion is the auditor's formal conclusion about whether the financial statements are presented fairly, in all material respects, in accordance with the applicable financial reporting framework. That may sound technical, so let's make it simple. The audit opinion answers this question: do the financial statements fairly represent the company's financial position and results? The auditor is not saying the financial statements are perfect. The auditor is not saying every transaction was tested. The auditor is saying whether the financial statements are materially reliable. That word "materially" is important. Auditors focus on misstatements that could influence the decisions of users, such as investors, lenders, regulators, and creditors. So an audit opinion is not just a formality. It is the final message from the auditor to the users of the financial statements. Now, there are four major types of audit opinions. Let's climb the ladder from the best opinion to the most serious. The first opinion is the unqualified opinion. This is also called a clean or unmodified opinion. It is the best audit opinion a company can receive. An unqualified opinion means the auditor believes the financial statements are presented fairly, in all material respects, in accordance with the applicable financial reporting framework. In simple language, the auditor is saying, based on our audit, the financial statements are materially fair. This does not mean the company is profitable. This does not mean the company is financially strong. This does not mean the company has no problems. It only means the financial statements are fairly presented. That is an important distinction. A struggling company can still receive an unqualified opinion if its financial statements properly show the struggle. For example, if the company has declining revenue, high debt, or operating losses, but those facts are properly recorded and disclosed, the auditor can still issue an unqualified opinion. So remember this: clean opinion does not mean clean company. It means the financial statements are fairly stated. The second opinion is the qualified opinion. This is sometimes called the except for opinion. A qualified opinion means the financial statements are fairly presented overall, except for a specific issue. The key idea is this: the issue is material but not pervasive. Let's break that down. Material means the issue is important enough to affect user decisions. Not pervasive means the issue does not spread throughout the financial statements as a whole. For example, suppose a company makes a material error in inventory valuation. Inventory is important, but the rest of the financial statements are fairly presented. In that case, the auditor may issue a qualified opinion. The auditor is saying, except for this specific issue, the financial statements are fairly presented. A qualified opinion can happen for two major reasons. First, there may be a material misstatement, often due to a departure from GAAP. That means something in the financial statements is wrong. Second, there may be a scope limitation. That means the auditor could not obtain enough appropriate audit evidence about a specific area. For example, if the auditor could not observe inventory and could not perform alternative procedures, that may lead to a qualified opinion if the issue is material but not pervasive. So the qualified opinion is not the worst opinion, it is a warning. It tells users, most of the financial statements may be reliable, but pay attention to this specific issue. The third opinion is the adverse opinion. This is the most serious opinion when the auditor has obtained enough evidence and concludes that the financial statements are materially misstated. An adverse opinion means the financial statements are not presented fairly. The key words are material and pervasive. This means the misstatement is not only important, but also widespread enough to affect the financial statements as a whole. For example, suppose a company improperly recognizes a large amount of revenue, overstates assets, understates liabilities, and fails to disclose major obligations. If these problems are material and pervasive, the auditor may issue an adverse opinion. The auditor is saying these financial statements should not be relied upon as fairly presented. That is a powerful message. An adverse opinion does not mean the auditor lacked evidence. Actually, it usually means the auditor obtained enough evidence to conclude that the financial statements are seriously misstated. So here's the simple way to remember it. A qualified opinion says, except for this issue, the statements are fairly presented. An adverse opinion says, the statements are not fairly presented. That is a major difference. The fourth opinion is the disclaimer of opinion. A disclaimer means the auditor does not express an opinion on the financial statements. Why? Because the auditor could not obtain sufficient appropriate audit evidence, and the possible effects could be both material and pervasive. In simple language, the auditor is saying, I do not have enough evidence to form an opinion. This often happens because of a severe scope limitation. For example, suppose the auditor is unable to obtain evidence for major account balances, cannot verify important transactions, and cannot perform alternative procedures. If the missing evidence is significant enough, the auditor may disclaim an opinion. A disclaimer can also happen when the auditor's independence is impaired. If the auditor is not independent, the auditor cannot issue a regular audit opinion. Now compare this with an adverse opinion. An adverse opinion means, I have enough evidence, and the financial statements are materially and pervasively wrong. A disclaimer means, I do not have enough evidence to form an opinion. That difference is critical. Adverse is a negative opinion. Disclaimer is no opinion. Now let's put all four opinions side by side. An unqualified opinion means the financial statements are fairly presented in all material respects. A qualified opinion means the financial statements are fairly presented, except for a specific material issue that is not pervasive. An adverse opinion means the financial statements are materially and pervasively misstated. A disclaimer of opinion means the auditor cannot express an opinion because sufficient appropriate evidence was not obtained, or because independence is impaired. Here is the classroom formula. Unqualified equals clean. Qualified equals except for. Adverse equals materially and pervasively wrong. Disclaimer equals no opinion. And the key decision point is this. Is there a misstatement? Is there a lack of evidence? Is the issue material? Is the issue pervasive? Those questions drive the audit opinion. So here's the big takeaway. Audit opinions are not just labels, they are signals. They tell users how much confidence they can place in the financial statements. An unqualified opinion builds confidence. A qualified opinion gives confidence with an exception. An adverse opinion warns users that the financial statements are not fairly presented. A disclaimer tells users that the auditor could not form an opinion. As future accountants, auditors, managers, or financial statement users, you need to understand these opinions because they shape trust in financial reporting. And trust is the foundation of auditing. So remember, auditors do not promise perfection. They provide reasonable assurance. And the audit opinion is where that assurance is communicated to the public. Thank you for watching Bite-Sized Accounting. Subscribe for more lessons as we make auditing and accounting concepts easier to understand. Making complex ideas simple.